Okay, well, hey everyone. Wanted to talk to you a little bit about mortgage today. And so for this, I wanted to introduce any of you who don't already know, president of our mortgage company, Brandon Wheatley. Brandon is one of the best mortgage loan officers in the world. And he's phenomenal. He's good looking, muscular. Let me see. Anything else that you told me to say, Brandon? Okay.
You missed like 4 or 5 things, but we'll get those later.
But Brandon's amazing. I can't believe he and his whole team, what a great job that they've been doing on mortgage. And I've never seen anyone do loans quicker or for a lower interest rate than what these guys are doing. So if you're in the world looking for a mortgage right now, either to buy a house or refinance, these are your guys you want to talk to. But I want to talk specifically about a specific issue today, and that is with if you have low credit. How does credit affect your credit score and a few things like that? And I know, so Brandon, let's just talk about that a little bit. How does credit affect someone's ability to get a loan?
Thanks for having me on your show. It's always an honor and pleasure. It's hard to believe it's been, 3 years?
I know.
Since we started this adventure. But yeah, thanks for the kind words. It's been our pleasure to help several of the Plum Tree agents along our past 3+ years of this adventure. It's been a ton of fun, and we've had a great time doing it. But yeah, credit. So credit does play a very big role in the financing process. And before we go any further, I'll throw my disclaimer out there. This is not legal advice, or this is not financial advice. This is purely my opinion on what I've gone through in the last 26 years of financing. But credit plays a huge role in financing. Obviously, the higher the credit scores are, the better off you're going to be when it comes to qualifying for the best products out there. The couple of questions that I've gotten, in the last 25 years is, hey, what's the minimum credit score you guys will do? What's the minimum credit score that FHA takes, that conventional takes? And I can kind of cover those in a nutshell. Let's start with FHA out of the gate. FHA, the lenders that we use, that Plum Tree Home Mortgage use, will go down to a 600. We've got one lender that goes to a 600. The majority of our lenders, though, want a 620. And that came about once COVID hit. I think there are some lenders out there that might go down to a 580. Again, I don't have any that I'm hooked up with, so to say, but there might be some out there. Again, our majority of our lenders want at least a minimum of a 620 credit score, and then one will go down to 600. Now, just because you have met that minimum credit score criteria does not guarantee that you will qualify for that loan. So I've had borrowers that are going FHA that were 640s and 650s and still didn't get approved. Now, could have been higher debt ratios, the amount of reserves, or the depth of credit. We can talk about that here and later on. But just because you have the minimum doesn't mean that you're guaranteed to actually get that loan financing done. So that's FHA. Conventional, we need a 660. Along the same lines as what I just said about FHA. Just because you have a 660 credit score for conventional, and when I use the word conventional, that means Fannie Mae and Freddie Mac, you might not qualify even though you have a 660. I had a few just this past month. I had a 675, 678, and we weren't able to get them done just because of, again, the credit score depth and some other compensating factors that were negatively impacting the overall profile of that client. So just because someone says, hey, here's our minimums, please don't assume that you can get qualified for the loan on that fact alone.
Okay. So why would someone want to choose an FHA loan over a conventional, and why would someone want to choose a conventional over an FHA? Can you explain a little bit about the difference between those?
Sure can. Yep. FHA is geared more toward first-time home buyers. However, with that being said, we do have a really strong first-time home buyer for conventional as well, which is Fannie Mae and Freddie Mac's product Home Path and Home Possible. FHA going down to the 620 credit scores, right, captures more of those borrowers who maybe cannot qualify for conventional. Some pros and cons for each one. We do both here at Plum Tree Mortgage, and there's no right or wrong. It's just what fits best for the client. FHA does have that 1.75, what's called mortgage insurance premium, which is stacked on top of your loan for your convenience. the government does that, but that is called the upfront mortgage insurance premium that FHA charges for doing the loan. The PMI, or the private mortgage insurance, on a monthly basis on FHA on a 30-year fixed will stay with you for the life of the loan. Whereas on a conventional loan, once you've fallen under that 80%, I think it's actually 70% loan to value, the mortgage insurance will drop off automatically. And when I say automatically, you usually have to call the lender and say, hey, I think my value is now above that threshold where I can remove PMI, and they might send an appraiser out there to do it. But whereas FHA, it will stay with you for the life of the loan. But again, FHA is not a bad product, right? It's a little looser on the credit scores and a little looser on the debt ratios. I've had some FHA loans that got approved with a back-end debt ratio of 52, 53% before. And for when I say debt ratio, those who might not know, that's your debt to income ratio, where you have to have your certain income requirements, levels be at a certain percentage. Convention had someone buzzing in there. Sorry. Conventional is pretty hard fast at a 45%. Might get a 46, 47, back in debt ratio if you have really strong credit scores and really strong compensating factors. But FHA is a little more lenient on the back end debt ratios.
Okay. So they look at their total income and then multiply it times that percentage. So if they're making $5,000 a month and they don't want to go over whatever the ratio is times their income, right? Does that sound
for
like
sure,
how they do it? Okay.
That is, and remember that is total debt to income ratio. So that includes your new monthly mortgage payment and all your outstanding debts. If you happen to have a car payment for $300, or you carry balance on credit cards, let's say they're $100 a month each, we have to factor that into your equation as well. So I always do it a round easy number for my simple mind, right? So if someone makes 10 grand a month, cut it in half, it's 5,000. So you can't have more than $5,000 a month in debt going out. So if they want to get a new $2,500 a month mortgage payment, they can't have a bunch of car loans, student loans, credit cards, and such. But yeah, try to keep it under 45 conventional, 50 for FHA. That's a very good general rule of thumb.
Okay, and so their payment then is calculated on what's their requirement for percentage of their income that can go to their payment? Is there a number like that?
Well, there used to be what's called a front end and a back end, and nowadays they really just pay attention to the back end. So I've had a couple of clients where they have zero debt, right? They're not making a ton of income, and their debt ratio is right at 49, 50%. FHA will still take that. Okay,
that's good to know. Okay, so then if someone does, maybe they're struggling a little bit with their credit scores, what are some of the things that cause it to drag down, and what would be some things they could potentially do to boost their credit score?
Sure. Well, the obvious, right, for the obvious in the room is to pay your bills on time. What we know, we've all been some
rule number one.
Rule number one. The biggest thing that I see that affects credit scores is the credit card revolving debt balances ratio to high limits, right? So if someone has $1,000 credit card limit and they're carrying a $900 balance, that's worse than someone who has a $10,000 limit and they're carrying $3,000 in debt on a credit card. So I tell clients, if you can keep it under 50%, that's great. If you can keep it under 25, you're even better. So we don't know exactly what the number of points that's going to give you for paying those down or paying those off. But I do tell clients, if you're carrying a bunch of revolving debt, if you can keep that under 50 to 25% of your max credit limit, that's behoove you to do so. Okay.
Well, that's some good information there on credit scores and all. I would say if someone wanted to come to you guys and get pre-approved for a loan, maybe a refinance or maybe a purchase, how do they do that?
Very easy. That is a great question for me. Thank you. www.plumtreehomemortgage.com. You can type it in your Google search or Bing search or whatever, or DuckDuckGo nowadays, I guess, right? It's a good one. So easy to apply online. If you don't want to apply online, you can call us first, right? We're always open to taking phone calls. We can have a 2 to 5 minute conversation to see if one of our programs is right for you and your situation. But by all means, give us a call. You can shoot us an email. We pride ourselves in being very accessible for our Plum Tree agents and clients. And again, it's our pleasure to do so.
All right. Thanks for taking some time with us today, Brandon. I know you have about 200 loans you have to go look after this afternoon. So I know you keep pretty busy. So thanks for your hard work over there, and I'm sure we'll see you in the next video.
All right, guys. Hey, thanks again. Have a great weekend.
All right. Bye.